Good evening, everyone, and welcome to tonight's live coaching live from Tradimo headquarters. I'm your Tradimo coach Jack, and in tonight's session, I thought what we'd do is we're gonna do a little bit of a concept coaching as well as our usual, where we go through, have a look at the markets, have a little look at preparation for the overnight session in Asia, including any data events that are out, maybe some potential trades there. But what I really wanted to do is, we've been talking about advanced scaling in. Some of these things we're going to actually start trading with in the trading room every day. So for example, tomorrow we're going to have a little look at, BVI and our little 5-minute strategy that I've been teaching, involving accelerator and parabolic SAR, and obviously discretion, as well as our price action. So I think it's a good idea to talk about advanced scaling in, because it does factor into some of the trades we'll be doing in the live trading room. If you are watching this as a recording, welcome. I hope that you enjoyed tonight's coaching. I hope the trading day hasn't been too choppy. I know the markets out there are very, very quiet after payrolls, as to be expected. It is also a Japanese holiday. So Bottle Torch, Brenza, Gio, Elena and the Goose, are you all ready to begin? I know that Brenza and Bottle Torch have both been very, very quiet and not traded much today. That's pretty much what I've been doing, guys, I'll be honest with you. So everyone ready? Yep, good. So let's crack on, shall we? So you'll see that I've put a little advanced scaling in PowerPoint for you in the Tradimo downloads. Okay, it's got a couple of techniques for advanced scaling, and it just takes you through the basic premise. Now, how many of you have actually used advanced scaling in before? Anyone? Now, there are two types of scaling in. Basically, there's the scaling in where you go with the trend. So if we pull up a chart here and we have a little look, let's have a little look at gold and find an example. Okay, there's an example where let's find when gold has been trending, which is, on the daily it's been trending for a while. So we can see gold has been coming off. Let's get rid of these lines. Normal scaling in, guys, very, very simple concept. Okay, we sell potentially, on a break of a minor support level on this area on the chart. Here, let's say we broke a little head and shoulders and we move down. And then what we do is, as price begins to move down the page, like we can see where the mouse is going, we add to that position. So, we might see a retracement and we scale in again for a short trade, and obviously price comes up. And that is slightly different to the advanced scaling concepts. Now, there is a very, very fine line between advanced scaling in and averaging, and we're going to talk about that in a second. So let's just pop on to our PowerPoint slide and do our standard practice, guys. Spread betting, FX and CFD trading carry a high level of risk to your capital and can result in losses that may exceed initial deposit. The trading of these products may not be suitable for everyone, so please ensure that you understand all of the risks associated with trading. The information and comments provided herein under no circumstances are to be considered an offer or solicitation to invest, and all information provided is believed to be accurate at the time of production, which is about 7:05 German time, Berlin time, 6:05 London time on the 10th of February 2014. As well as this, guys, nothing in herein should be construed as investment advice. Information provided within this room is the personal opinion of the moderator, that is me, Jack, and not Tradimo. And the content does not constitute financial, investment or tax advice. Tradimo does not accept any liability for the content of or comments on during the session. So as always, guys, these are my strategies, my opinions on where the market are going. They're not recommendations, and they're nothing to do with Tradimo itself. So if we pop up to the advanced scaling in, hi Gio, Elena, how's it going? If we pop up to our presentation, you can see I've done you a nice little presentation, guys, that you can take away with you. Now, advanced scaling is very, very simple. Okay, it's a technique where a trader enters a position in stages. Okay, and like we've talked about, generally two types of scaling in. We're going to focus on the one where we do not enter the trade as the market goes on side. We're actually looking to enter into a trade as the market goes the other way. Okay, so for example, what we would be looking to do is, say that we wanted to be short gold, maybe around this point on the chart. Okay, we can see that, we have a bit of a top. Okay, in fact, let's do it here so it's easier. Okay, we would sell some of the market here, and with advanced scaling in, generally what you do is the market will go against you. Okay, and then you will enter into a trade again at, say, this point. Okay, and what that means is, guys, it means your average actually gets moved higher. Okay, and there is a very thin line, as I've said, between advanced scaling in and what we call averaging. Okay, does anyone know the difference between scaling in and advanced scaling in and averaging? Any ideas? Any ideas for anyone? Basically, advanced scaling in is where you strategically place your offers or your bids before the market actually moves against you. Okay, when you're averaging, what traders will do is they will say to themselves, oh, I fancy selling this gold. So they might sell some gold at this price here. Okay, they will sell their 2% risk, they will sell 100% of their position at this point in the market. Okay, on this blue line here. Okay, now we know that you should never risk more than 2%, but someone who averages will generally, when the trade goes against them, so we can see price moves higher, they will just sell some more. Okay, and what they will do is they might sell, 2%, they might sell 5%, but generally what they are doing is they are throwing the money management principles out of the window. Okay, whereas with scaling in, what you will do is at predetermined periods in the market that you have already planned out in advance, you will risk the total amount that you want to risk on that trade. So you might risk 1% here, and then you've already decided that you're going to risk 1% here, like this. Okay, and that way you never exceed the 2% rule. And it's very, very important that you understand the difference, guys, okay, because it can be very, very dangerous to just start selling it. Funny story, well, it's not really a funny story, but first guy I ever sat next to 7 years ago when I started trading, he used to scale in, advanced scaling, okay, and what he would do is he would gradually sell a market as it went up, okay, he would fade the move. But one day, the move went against him and he just started randomly selling it on its way up, which is known as averaging, and he wiped his account out. So it's a very, very much for people with discipline. It's generally used for taking advantage of retracements. And so if we pop our slideshow up, okay, it's generally for taking advantage of retracements when a trend is already in place. So it's very, very important that when you scale in, you either have a range or a trend that is in place. And the idea, as I've said, is to enter the market several times as the market moves back against the overlying trend. Does everyone follow me so far? Everyone following? Good. Now, we have already talked about this when we talk about the euro. Remember, guys, okay, we talked about this euro having a big move a couple of days ago. And I'll remove these lines that it will come clear in a second. So if we zoom in the chart and we put a nice little box around this candle here, okay, right. Basically, 2 days ago after ECB, we said to ourselves, market was very bullish. We had a big bullish engulfing pattern, engulfing our 2 days of indecision. And on the very next day, what we said to ourselves was the following. I said to myself, well, we've had a big, big signal to get long. We've had some big, big, big volume, a big candlestick pattern. And as well as this, we have rejected a very, very interesting intermediate support level, which we will mark in purple. Now, on the next day, what's happened is we are thinking the trend is going to continue. And remember how we talk about our scaling in? Basically, what we do is we see the open of the day here. The open of the day here. And we say to ourselves, okay, I'm going to buy a certain percentage of the trade. Remember, I say to you generally that I will risk, maybe 0.5% on the open, depending on how much you're going to trade, guys. Okay, so we will buy 0.5% on the open. Then what we will do is when we get down anywhere between the 23, and let me just get rid of this candle here. So ignore this candle, guys. And basically what I say to myself is when we get down anywhere between 23.6 and the 38.2 and so on and so forth, we look to get long. So on this candle is the actual example. So this is from Friday, this is today. And what we do is basically we look to average in. So the most recent example, actually guys, wrong candle on the chart, apologies, there we go. It's on this one here, Fibonacci's in the wrong place. Let's delete that and start again. So it's very, very simple, okay? This is the candle here, this big blue one. Okay, if we take our Fibonacci and we just place it on the chart, on this line here, and we just make this one a little bit bigger, so we just make this down like this. What we're looking to do is we're looking to average in as price moves back into the body of the candle. Okay, so it's very, very easy to do. So we would buy, as I say, 0.5% on the open of this candle here, and then when we hit the 23.6%, we might buy another half, and it goes on and goes on until basically we pull back and we have our total 2%. And then what we look for is we look for a drive higher. Okay, and we've been talking about that in the trading room. It's what I say to you, what I like to do, you know, after a big red candle here, you know, on this open of this candle, we say to ourselves, well, we've had a really, really big move. So we take our Fibonacci and have a little look, guys. We sell half of the trade on the open here, and then we look to sell maybe some of the 23.6 or the 38.2, guys. It's up to you how you do it, but generally I'll sell it here, here, up to the 50% with the stop maybe above the high or even above the 61.8. And so at this point, we now have, you know, our full trade on, or 0.5%, and if we're looking to risk 2%, we just maybe sell maybe another 1%, because it helps us, instead of having just one sell on the open, it actually helps us to improve our average. Our average is actually, you know, about 10 pips better, and if we get the whole trade, it's probably about 20 pips. Okay, so everyone follow so far. We've talked about this in the trading room. Okay, there are lots and lots of different ways to do this. Everyone following me so far? Brenda, you, Elena, Goose, Bottle Torch, everyone happy with that so far? Good. Okay, now as I say, it is for advanced traders only. You must have a significant reason to believe that the market will continue on in its original direction, okay? And it should not be used in a non-trending environment when prices are choppy. You can look to use them during ranges, but it's very, very much a case of, if we pop back to the chart and we have a look, you need to be careful, okay? So let's take this euro, for example, here, okay? If we start by marking up some daily levels on the chart, and then we mark some other levels up on the chart here, okay? Generally, advanced scaling in is better for using during consolidation. When a market is ranging, like we can see here, okay, if we insert a shape, we can see that the market, in this period here, is clearly in a range, okay? The problem you've got is market trading is very choppy. So, you know, market comes down to this level, you'll look to buy it. But the problem is, the market could do anything. It could come all the way back down here, it could come all the way back down here. Generally though, when a market is trending, okay, plus the range could break. When a market is trending, as long as you have a significant reason to believe that the market will continue trending, maybe there's a good piece of data, maybe there's some you know, consolidation patterns forming, it will generally help you to actually optimize your trade, okay? And it basically, it's a probability trade. And what I mean by this is, let's have a little look at the euro. Okay, we can see that the euro breaks down and then it begins to trend into an uptrend at this period here. Now, all of a sudden, okay, we decide to ourselves, we're going to want to get long. Okay, so the market is trading at this point here. It's maybe overbought. So we're not going to buy it now. What we're going to do is we're going to look for a retracement. And to do this, lots of different ways. I'm going to show you some methods. We could use support and resistance. Okay, let's take the simplest form. Okay, and so what we decide is, well, we have a level here on the chart, that's very good support. But remember, guys, we talk about support and resistance zones. And the problem we've got is, you know, we could buy it here, but the market could trade all the way down to that 125.97. So what it means is, you know, there's a 200 or 140 pip range where the market could trade, because we know that prices will not just trade the same price. We can see here, we have a support level. Okay, quite clearly it's a support zone that's now a resistance zone, but the prices will never trade at the same point. We can see, you know, we trade on this candle here a lot lower than, say, we trade. So averaging in is wrong, but advanced scaling in at this point enables you to trade the support or the resistance zone. And if the market gives you an indication it's trending, so we can see quite clearly the market's going up, maybe there's a piece of news that's come out, okay, you wait. And you just basically wait for a nice reason to get into a trade. So we can see at this point here, this rectangle, okay, on the chart, market's moved up, it's pulled back. So, you know, we have support level and we have a support zone here. We also have, you know, a bullish engulfing pattern on the chart. So we say to ourselves, well, you know, I don't really want to buy it here. Does anyone know why we wouldn't want to buy it here when we've got two levels here? Any ideas? You know, why would we want to risk 2% here? Any ideas why we wouldn't want to do that? Ranging, yeah, there is a potential for that. Actually, we have just broken into a bit of a trend. Okay, we're looking at just this area here where we've had a very bullish reversal signal, and we've now maybe got a piece of news. There was some news around September that was quite positive. The main reason is because if we buy it here, we're actually buying it at 128.74, but we have a nice candlestick and we have some nice volume. Okay, and we've moved back overbought now, which is good. The market is grinding, it's having trouble breaking over. But at the same time, our actual level is here. Now, obviously, we want to get long now. Okay, we have a bullish bias for whatever reason. But the problem is, okay, this is the actual area on the chart. This level here and this level here. But there's no guarantees it's going to trade down. So, if you were to put all of your 2% on here, the market could still trade off another 100 ticks. 200 ticks before bouncing, and that would mean that if price does come down here, okay, and you're long 2% of your account here, you know, it's got to come all the way back before you move on side. Whereas if you were long 0.5%, because we have a very good buy signal, but it's, you know, maybe not the ultimate buy signal, and then we know that we have a good support area, so maybe we wait for a rejection, we'll risk another 0.5%, we risk another 0.5% here, or, you know, total of no more than 2%, even 1%, okay? We know that our average price is actually bang on this support area on the chart. And as we can see, you know, in this case, price does come back. We can see that it bounces up and then it bounces back to this support area on the chart. This area on the chart here, guys, that we've already marked up as a good support zone. So, you know, if we'd bought it here, yes, we would have gone on side, but ultimately we would have gone offside. Whereas if we buy it here, here, and here with the same amount, you average in, you get an optimal fill, and you can actually trade the consolidation pattern. So very, very simple introduction for you there, guys. Okay, that's the basic principle of why we do it. Okay, when it comes down to how we do it and you know, the risk involved, you know, we're going to talk about that. Any questions so far? Anyone? Okay, because there are a few rules that I actually use for scaling in. Okay, and you've seen me scaling a couple of times when we've traded in the trading ring. Okay, generally you will trade no more than 3 or 4 positions during a trade. Okay, we split our volume by 3 or 4 positions maximum, and the reason we don't have any more than 3 or 4 volume positions is because generally it gets very, very messy. Okay, it gets very, very messy indeed, and the most important thing, as I've said before, you've got to always plan the position before you put it on. Okay, the most important thing you're going to do, guys, okay, you need to know where you're scaling in. So we come to a chart, okay, and we say to ourselves, let's look at the euro again, okay, let's pull back. Let's pull back to the daily, just before it starts. Okay, it's in an uptrend at this point here. Here, okay, we're in an uptrend, clearly moving sideways. Okay, we've always got to know where we're going to enter the trade, because otherwise we're averaging. We get a nice hammer, we maybe buy in here. We can also see we have a support level here we might want to enter. Okay, very important that you don't just randomly enter the market. Okay, because 1, you can risk and blow your whole account, and 2, okay, you end up with a less than optimal fill. So instead of, you know, an average down here, you end up with an average up here. Okay, so you know, always plan, guys. Planning is the key to success when it comes to trading. I can't stress it enough. So, 2 types of entry, guys: aggressive entry and conservative entry when it comes to scaling in. Okay, the first entry is always crucial when it comes to trading both types. Okay, so aggressive entry, guys. The rules of the aggressive entry are that you use majority of your position at a level, okay? And the reason you would do this is because you have a very, very strong feeling that the market is going to have a bounce. So I'm going to show you an example that I actually traded going back to November 2012. It's actually on the chart and it's around about here. Okay, so remember our price action tactic when I talk you through this. Basically, the aggressive entry is for an entry when you want to potentially scale into a trade because you want to protect your money management and you want to give yourself optimal entry. Okay, but the aggressive entry is when you are quite confident that market is going to continue on in its little uptrend that we've got here without pulling back too much. And an aggressive entry is generally best used during periods of consolidation. So we come to the market, okay, and from this candle onwards, we see that we're in a bit of an uptrend. We then zoom in a little bit so you can see a bit clearer. We can see that a bit of a range forms in the market, guys. We have a little bit of a top here with the doji, and we have a little bit of a top here, okay, and I'm going to mark these levels out in purple just so they're a bit clearer for anyone watching. And at this point, we see, I'm confident the trend is going to continue in the euro. There's a lot of good news around this time about bailouts and lots of other things. And so I potentially want to enter into a trade, but I'm quite confident it's not going to break out of this range too badly. So what you would do is, because we have the consolidation pattern, we know that if price breaks down below this consolidation, it could come all the way off. It could signal that we're going to move lower. So it's a big, big level, okay? So, we can see that price actually breaks down, and then we can see that our range actually changes, and we come to our support level here, okay? And then we get a reason potentially to be long. What's the reason for being long here, guys, based on how we trade price action? Any ideas? This little candle here, these three candles here. What do you see on that chart? We see a doji, yep, okay. So that gives us a little bit of confidence that market might reverse. We have RSI around 30, and we have much higher volume than the prior day, and on par with our move down. Okay, so at this point, we think to ourselves, cool, this would be a good place to get long, because as well as the RSI, the volume, and everything else, we also have a consolidation pattern. Can you see on the chart, guys, the range? We said about markets moving in steps? Well, we have a potential step, don't we, where price goes up, moves sideways, and carries on. Okay, and so in this instance, you would probably look to trade a bit more aggressively. So if we were risking 2%, guys, how much do you think we would be risking on this trade? And let's just mark this up in a lighter turquoise so we can see the long. What do you reckon? Using an aggressive entry. 1%. Absolutely. Generally, the rule is if you're going to use an aggressive entry, you're going to look to place around at least half of your overall trade. So if we were trading 2%, if we think that price is potentially going to bounce from here without retracing lower, but just in case, we want to give ourselves a good average, okay, what you do is you would buy at least 50% at this level, okay? And obviously your stop loss would go below the low of your next buy order. So we can see, as well as this support area on the chart that we have highlighted, and let me just get these horizontal boxes, rectangles, as they are actually called. There we go. So we can see we've got a good hammer, but again, the actual level is a little bit lower. It's at, it's between this purple and blue line. So we'd say I'm going to buy 1%, and then what I'm going to do is I'm going to also look to buy maybe 0.5% here, and then you'd say to yourself, I'm going to buy another 0.5%, maybe a little bit lower. Okay, but here is the crucial thing. We are not concerned if we get this fill. Yes, we might trade less size than we ideally want to. We're not bothered about that. Okay, very important you remember that, guys. It's for times when you think the market could bounce. You've got at least 3 or 4 good reasons to think it's going to bounce, but there is a chance that because we have a support zone here that coincides with all of these highs on the market over here, we're happy to also try and average in a little bit, hedge ourselves. And as we can see in this example, price actually moves straight up, which means that you would only have 1% of your trade on, but because the signal you've been given is so strong, it actually helps you to get your trade on. Okay, it's aggressively done, guys. Now there are risks for that. A conservative entry is slightly different. A conservative entry would be we buy equal amounts of the trade on the entry itself, or we would buy the smallest amount. So, for example, okay, let's say that we're in the market here, okay? We have got 2 good support levels on the chart. Can you see these support levels on the chart? Everyone happy that these are very, very good support areas? Everyone happy with that? Everyone think, you know, these are 2 good intermediate levels in this area here on the chart that we have, the 2 purple lines? Yeah, absolutely. I'm happy. I think they're very, very good levels. Okay, so with a conservative method, guys, generally it's for when you have a level that's not as strong as maybe it could be, or when you have multiple levels in the same area on the chart. You know, if we actually look on this daily chart, we can see that our euro here has a big support zone again. And that support zone is the low that we see on this candle in our consolidation pattern. We're making a nice little bit of horizontal support and resistance as a consolidation, a step. But as well as that, guys, the actual sort of level that we've traded down to, you know, it could be here, over here, but also it could be here, it could even be here. This is where we had trouble breaking above, and when we broke above it, we broke cleanly. So, you know, for me, the first level is always a weaker level. It's always a green level or a purple level. And the second level is always the red level, or, you know, if you're trading with a green level, it's always the purple level, or it's always the purple and the red level. Everyone follow so far? Any questions of what we're talking about? Any questions, any confusion? Now, okay. Okay, cool. So the aggressive entry is where we're confident price is going to move higher, like that last example. Everything's telling us price is going to move higher, okay, in a trend. We're in a trend, we've seen a pullback, and we're confident price is going to carry on. Consolidation pattern, maybe, okay? The conservative entrance is you trade less on your initial volume, okay? Less initial volume on your initial entry. And so what you will generally find is your initial entry will be, you know, around a support or resistance zone, but you can see quite clearly on this daily chart, the daily level is here, this 126.30, but the intermediate level is this 128.11. And so I wouldn't want to just buy it here. One of the reasons is because we have a double top forming, and, you know, I would rather buy it on a retracement. And so what you would do is, rather than risking 1% like we did last time, you would risk maybe 0.5% here, okay? And on the second level, you would maybe risk 1.5%. Or you could risk, you know, multiple, 3 or 4 times, okay? Because you are less confident that price is going to bounce from here, but it still could. It's still a good level on the chart. And boy, robot, this is something that you should definitely keep an eye on and have a look at, because a few of the trades you showed me would have worked wonders if you'd actually, you know, maybe used a little bit of advanced scaling. So, does that make sense to you, Elena? Yeah? One level, the first level, is maybe not as strong as the second. And it generally can be, as I say, you know, the distance between a support and a resistance zone. We have a nice resistance zone level on the chart here, but we also have another resistance zone. So we, you know, a level which is formed a resistance zone. And so for me, you know, the bottom of that resistance zone is the support zone, sorry, that was a resistance zone, is now the best place to get long. Okay, so they are the difference between, okay, the conservative and the aggressive entry levels. Okay, if we just pop back to the side, we can have a little look about this one. Okay, you know, we can see that the first entry is your largest on an aggressive, each, or it could be small amounts. Okay, it can be one or other, but generally you will never trade more than half on a conservative entry, and generally, you know, your first entry will be smaller than potentially your second or third entry. Again, always planned out in advance. So, to identify retracements, guys, this is the first thing we need to be able to do. Okay, so how can we potentially identify retracements in a trend, guys? Any ideas? You can see it in front of you here. Boy Robot, this is directed at you, mate. So, if we take our Aussie dollar, okay, we get rid of our lines. How do you think we can identify a potential retracement? Fibonacci, absolutely. We can use Fibonacci. We can use candlestick patterns. We can use consolidation patterns. So, okay, here we go. We have an Australian dollar here that's moved down. We've identified it's in a strong trend. We know it's in a strong trend because we've been ranging between the two levels on the chart here that we will both mark up in red because they are strong daily levels. Okay. We have then had some fundamentals that tell us the Aussie should be getting weaker, and we've also broken a big key support level and retested and broken lower. Okay, so what we can do is we can use candlestick patterns like we did with the euro. We can use support and resistance. These are generally the easiest ways to do things. So on the chart straight away, we can see that we have an intermediate resistance. Okay. If we were to take this down to a 30-minute or an hour chart, we could see that we have a support that's now a resistance. And so for me, there are two areas on the chart I would like to get short at. Okay, the ultimate level is here. Obviously, it's the big daily level. But I'm a little bit worried. I don't want to miss the move. We're in a strong trend. We've got a little bit of divergence, so I think market's going to back. But, you know, potentially we've got a resistance here and we've got a consolidation pattern. We've got, you know, little bit of a downtrend that's forming a little bit of a channel on the way down. So I don't want to miss the trade. So what I'm going to do is, instead of missing the trade, I'm going to look to get in at the whole area. Okay, so what you would do is the next time we pulled back towards that level, and again, let me just zoom in so it's a little bit clearer for us. So, next time we get back to our purple level, we probably look for a conservative entry. So we can see that price moves up towards our support area on the chart. What do we see, guys? What about here? Not a trick question. What are we looking at, Brenza Boy Robot? We've got a pin bar. Doji, absolutely. The volume is okay, it's not great, and the RSI isn't oversold. But we know that we are in a downtrend already, and we know that potentially this downtrend is going to continue because of our sentiment. So, in this case, would you look for an aggressive or a conservative entry, guys, knowing that our daily level on the chart that we have already shown you is here, this big red one? What do you reckon? Conservative, conservative. Elena? +1. Okay, yeah, you're Delta. Okay, yeah, you're absolutely right, guys. If this was me, I'd use a conservative because basically, guys, prices moved down, and we can see that we do have. And let me just put a little green shape up on the chart here for us. We do know that we have got a consolidation pattern that's forming. This, oh, that's not the best color, is it? Let's make it a bit lighter. There you go. Okay, we know that prices move down and it's ranging. Okay, this is a consolidation pattern with horizontal support and resistance. So potentially we should be selling it here to buy back for a break lower, continuation of the trend. But we actually know that we are yet to retest properly this 96 level. So for me, you know, I would want to maybe sell a little bit here, but ultimately my big short that I'd want to put on would be up here. You know, maybe just below that resistance level that we now have that was a support. Okay, so we'll pop a purple line there. So in this instance, what I would do is I would probably risk, you know, maybe 0.5%. I would then look to risk maybe another 1.5% if we're using 2 entries around here. Because the thing is, if we do continue to consolidate and the trend breaks, I don't want to miss this trade. But at the same time, I don't want to be selling all my position here when this is the actual big level we should be getting involved at. Another way you could do it is by scaling in more than once. Okay, so we could leave our big entry around this line here. We could sell around our purple line, and then somewhere else on the chart, so on this high here, we could say to ourselves, actually, we're going to risk another 0.5% on this orange line. Okay, and you can just see, guys, that it's conservative. We're looking to scale in over 1, 2, 3 positions with the big level, the big level that should hold being the main place to enter. Okay, and as I say, identifying is very simple. We have consolidation patterns. Okay, we can use consolidation patterns such as this. We can also use anything that you like, guys. We can use things like head and shoulders at the top of the market here. After a big move down, we have a pullback. So you could use a head and shoulders. So we can see that we form a little bit of a head. We come down and we form a little bit of a shoulder. And so what we would say to ourselves is, I'm going to sell some here around the shoulder line. But we know that that head and shoulders is a valid pattern as long as that peak here that we have remains intact. As long as the shoulder does not go above that height. So I might say to myself, I'm going to sell it here, and I'm going to sell it here, and I'm going to put my stop loss above that head and shoulders. And in this instance, it would probably again be a conservative trade because I'm confident that this Aussie should be going lower. Okay, we've just moved out of overbought. Good volume on this head and shoulders, rejected every time that we have a move down. The volume is very high. And okay, we don't get filled necessarily on the rest of our trade, but you can see we can use multiple candlestick patterns. Okay, another way to do it, guys, as I've said, to identify a potential pullback and a potential retracement is by using Fibonacci. Okay, so again, we have a big move down. Very simple, guys. You take a Fibonacci. Oh, again, he gets it wrong. You take a Fibonacci. We take the high of the move, which is the swing high here potentially, and then we say to ourselves, right, we have a level around 23.6. I'm going to enter into a short here. We have another level at 38.2, which is actually our big level, guys, if you remember, the big support and resistance level, but we'll just pretend we're using Fibonacci. So we have another sell, and then we say to ourselves, well, that 50% is also a potential area because it is actually where the bodies, can you see how the bodies don't close below this level here? So we say to ourselves, we're going to sell at the 50%. So there are lots and lots of different ways that you can use advanced scaling in. Everyone follow me so far? There are lots of ways you can identify retracements in a trend. Generally, a retracement is where you have a big move down and then price will start to move. You know, it will pull back a little bit, but generally you'll see a dip in volume as we pull back. So the initial trend, big volume on the downtrend. Volume will generally be a lot lower and you'll just see a bit of a pullback, you know, market going against the trend. And then bang, you'll see maybe a candlestick pattern form, maybe a double top here. We've got the head and shoulders on the chart, shoulder, head, shoulder. Maybe you get a bearish engulfing pattern like this one here. You know, we can see a very big bearish engulfing pattern there. And that gives you the signal. Maybe it's a bounce off a resistance level, like we said. You know, maybe it's a bounce off a very big resistance level or support level. So in this case, our support and resistance level is around here. and we have that bearish engulfing pattern, and that's generally how you will identify retracement, guys. You will see that volume are very, very low. Okay, generally it's a bit lower than, you know, the prior move down, and you'll see that market is struggling to move against the trend. So another example of that, guys, dollar CAD, another market we've been looking at, that is potentially looking to form a retracement, although I haven't seen it today. So we can see that price here is clearly in the last 4 months moving up. We can see that we have a break above a big resistance level here on the chart. Apologies, let me move this back. We see we break above, and then we can see that we break back below, but we don't just stop at this 106 level. What happens is we trade around there a bit, and then we move up. Can you see this area on the chart here, guys? Okay, and this is the whole point. Okay, the actual level is here, but we know that the actual resistance zone is all of these candles, all of these wicks. So you would buy it, you know, at multiple positions. And with this CAD, perfect example, we've moved up, we formed our step, we've moved up again. So now we're looking for another step to form. And guess what, guys? Potentially, there's no guarantees, we could be reversing. We've had a very, very big rejection, but potentially, can you see now, guys? We've got horizontal support and resistance, a support level that was resistance here that we're having trouble breaking below between this 110.29 and this 109.70, and we're moving sideways. And I'm sure if we look at the volume, with the exception of maybe a couple of candles, that volume could be quite low. So we can see that, well, actually the volume's been really high, but if we actually break that down, we can see the uptrend had some pretty big volume, and we pulled back. The volume's actually pretty high, but then the volume died down. Can you see at this area here how the volume died down? And then we break higher, the volume spikes up, and we can see the volume is already here beginning to move lower. Can you see that, guys? And we're moving sideways. That tells us potentially consolidation. If we have a big move down with big volume, that tells us potentially the trend's going to break. So we have another step forming. Any questions so far, guys? So we're going to move on to trading with it, because there was a very, very good example today, guys, in the market. Okay, so as I said, we start by entering the trade using a small proportion of the money that we want to put on, and as price moves against us, we put the trade on. And these slides that I've got you guys are predominantly for you. Now, as I've said, there are sort of 3 or 4 main ways of using scaling in. Okay, and these are support and resistance. Okay, so as I've said, if we just pop up MetaTrader and we have a look at an example from today in cable, we start by marking our levels on the chart. So we mark them up in orange for important levels. Excuse me. So at this point, you know, we have quite an important resistance. Everyone happy that that's quite an important resistance? We then have a little bit of a sort of intermediate support. I wouldn't say it's as important as this one here. So maybe we mark this one up a little bit less than the other one, and then we can see that as well as this, we have that big daily level on the chart, guys. Okay, so with our bullish sentiment, what we would do is we would look on a break out of this level, we would look to enter into a long trade here. And in today's example, you know, we've broken the resistance, we now get a retest. So we look to go long, and we probably risk, you know, maybe we risk 0.5%. We're looking to risk a total of 2%. Okay. We then decide that actually, you know, this support zone, this resistance zone is very, very important. We could come down to this level. So, you know, we risk 0.5% on the initial entry, but there is a possibility price is going to move lower. So what we do is we risk maybe another 0.5%. okay, at the green line. Or what I would do is, if it's a more important level, risk 4. If it's just a little green level and it's not a purple level, I generally won't risk as much. So we have 1%, aggressive entry. We then have our little 0.5% on this green line. And then guys, you know, we can see that we also have this big daily level. So if we were looking to get into the trade, we know this is a huge level. You know, you might want to risk another 0.5% here. Or what I would rather do is, because this is a huge stop loss otherwise, I can see that we have a very, very minor support here. That's a resistance, that's a support. And so that's a green level. I'd probably risk another 0.5%. Okay, so at this point, this is where we're looking to enter into the trade. Okay, we've got our 3 levels, we've got our volume. So on this candle, on the very end, we've basically entered into a long trade, and the market has now started to move against us. And let us just zoom in a little bit. So then what happens is we've got our 1%, we've moved down to our little 0.5% level, our little green level that we have on the chart. Okay, so we are now long 1.5% on the chart. Okay, trades on, we're looking good. We don't quite move down to our sort of support area we have on the chart here, so we don't get filled on the 0.5%. See that price has a little bit of a bounce, and then we begin to move up. And these are trades over non-farm payrolls. These are trades, very, very recent trades. Okay, and then what happens? Obviously, we are in a very, very good trade. A more recent example, if we want to have a little look, using support and resistance, guys, actually comes from sort of today. But bear in mind, it's been a choppy day. So advanced scaling in might not be for everyone. We can see that we have a very minor resistance that could be a support, sort of around this area here on the chart, guys. Can you see we've pushed back twice and now we can't get below there. So we might decide that we're going to buy it around this peak, but very, very small. We then know that we have a very, very good purple level on the chart. We can all see that it's this resistance that we broke up from. Everyone happy that this is a good level? Here. And so in this example, what I would rather do is, if I have my long bias, and remember guys, you should always have your sentiment and your bias in where the market's going first based on your trade identification system. I would risk probably, you know, oh, excuse me, let's put this into percentages, actually, it might be easier. I would probably risk 33% of the trade there, because this level is such a little level. I wouldn't even risk that. Maybe I'd even risk 25%, because we have a high, but it's such a small level, guys. You know, it's not like this level where we can see that price has had real trouble breaking above this sort of area. Look, we have a peak, as we move back, another peak, and we've bounced a lot every time. So in this instance, you know, the green level would probably give you a nice trade if it goes on side, but I don't want to risk 2%. I don't want to be long here and the market come and test this level, because then I've got to wait for the whole market to come back. So in this example, I would probably risk 30% and, you know, 66% here, which, you know, basically that is 2/3 of the trade. So we move along and we can see that we get filled, market gaps, and moves higher today. And then you can see, look, we break back down. At this point, I'm still happy to be long the trade. And we can see that we haven't broken back down to the 66% yet. Okay, so the easiest way to do it is around support and resistance levels. Okay, the way that we've been teaching in the trading room is slightly different, and it is by using Fibonacci and Candlestick Patterns. Everyone remember our scaling in tactic? We can see in this slide, now the use of Candlestick Patterns is very easy to use. Okay, we look for price to retrace, join and move. So in this example here, okay, let's cut all of this out and ignore this here. We can see the price moves up. Okay, what then happens is price moves down. Okay, and then we get a big hammer here. Can everyone see that? And you see that on the next day, we open, we retrace down, but because we've got that hammer, we know that price shouldn't break below the low of the hammer, so we can look to enter at different increments. Okay, so we have a nice hammer pattern, gives us a good potential long position. And then what happens is the rest of your entry is placed within the range of this hammer pattern here, hoping that market moves down and then, moves down and then moves higher. And as we know, the stop loss is placed below the hammer. So let's have a little look at an example of this, shall we, in the market. On the daily, if we pop to a daily, there's been a very, very, very good example of this. We've talked about it. It's one of the ones we've been talking about for ages. It is literally 2 weeks ago. Okay, we've basically seen cable have a big, big, big move up over the last 6 months. Okay, we then get a blowout pattern. Remember I say we have two big candlestick patterns, you know, like a bearish engulfing one here, market moves down, then comes back, it forms a new high, and then as soon as it forms that new high, very quickly it just blows out and moves lower, okay, with an even bigger bearish engulfing pattern. Well, on this day, it's very, very simple. Okay, using aggressive scaling in, I would want to be short at this point here. But I would also be very, very, very worried, okay, about the fact that we're entering at this level, but potentially, you know, we could still trade up. There is a resistance level at, you know, this area, this 166, 166.80, you know, 70.80 level, okay? And so what I would do is, rather than selling everything at this point, I will use the candlestick here as my signal. So you would basically do it in increments. So we talked about how potentially good areas are the open and close of the prior candle. Things like the hammer pattern are a good example. If you've got a hammer pattern like we have here, we can see that, you know, the low of this day, actually where we retrace to is not far off the low. On this candle, we retrace to the low of this day, and then we move higher. If we take another example of a strong signal, we can see that again, you could have entered in on the open here, and then scaled in around the high of the candle. So with this bearish tweezing pattern, what you would do is you would sell some on the open, you would also sell some around the open of the candle before, and then you would probably sell some more at the high. Now in this example, what I would do is I would do a more aggressive entry, and it's not because I know what's going to happen, it's because if price comes all the way back up here, I'd be very, very worried. I wouldn't be expecting it to come up here, but I would like to hedge my bets anyway. And then your stop loss, guys, as we already know, it goes above our resistance here. Okay, so candlestick patterns are another good way, using the open and close of prior candlestick patterns. Any questions so far, guys? Jurelena, Goose, Bottle Torch, Boy Robot, Brenza. You've been very, very quiet tonight, guys. Any questions? What do you think of advanced scaling so far? A bit scary, can it be? Do you think it's going to be quite scary? It is a bit swing trading, yeah, and so you have to be aware that you could damage yourself a little bit doing it, so you need to be a bit careful, okay? And, you know, the final way to do it, as we've talked about, is if we have a little look in the market here. Again, we're probably going to have to zoom in a little bit just so we can see the candle. Is on this candle here, guys. Okay, let's highlight the candle. This is the candle here. There we go. And we will be using everyone's favourite. One day I will actually put it correctly onto the chart. I can always do it the other way around. I just can't get used to that thing. So we have a nice bullish reversal candle pattern forming here. okay? But we also have some good Fibonacci levels. So what we would do is we would look for a retracement period in that candle. So we would look around the 23.8, we might go blue, nice light blue, everyone can see it. And maybe we use the 38.2, okay, and then maybe we use the 50%. And we can see on this day, very, very hard to see, but you can see on this day here, we actually traded down perfectly to the 61.8. Can you see that? Look at the low of the day. The 61.8 comes in at around 163, which is a big psychological level. The low of this day, 163. Okay, and we can see we have 3 equal points we can get in, and as always, the stop loss goes below the low of the candle, or in this case, probably below the low of the swing low. Okay, and Fibonacci is one that I've been using a lot of recently. The important thing about scaling in, though, if you are going to use the single candle, the prior candle, and use Fibonacci, is for me, with this method, it's very important that when we open, we break lower before we move higher. We don't want to test through the high. And the reason is, guys, as we already know, if we look at that dollar yen, there is a real good example here on the daily. Although we are bearish today, let's get rid of our lines. We can see that we got a very bearish candle here. We broke through 170, which was a big support level. If you remember, guys, it's the head and shoulders shoulder line that we had here. Can you see that on the chart? And on this candle, we broke through it. Then on this candle, we broke through it. Then on the next day, have a little look what happened. Market actually opened here, ticked down and broke the low, then retraced in. Yes, it did come back in the end, but then we saw a reversal. For me, it's a probability trade. We open here, we should test through the low, but I want to see it bounce up first. It's a probability trade. You can close them all. It's no different to trading with ordinary methods. The only difference is you're trying to pick an area on the chart rather than the perfect level to get in. Because how many of you have sat there with a trade? Okay, how many of you have been, for example, looking to get on the market that wants to go up? So dollar yen, another perfect example. How many of you have looked to buy maybe dollar yen, or look to trade a retracement, but the area on the chart is, you've got a few levels around there. If we highlight this area and we zoom in, how many of you have ever seen this? We've got a very good area here. We've got a big consolidation pattern forming, but at this point, have a little look. We've got the low of the consolidation pattern is here, but that doesn't mean that that's going to be the low of the consolidation pattern. We also have a little bit of a peak, here in the market, a little bit of an area in the market here. And so, trying to buy it here, and then you end up sitting offside this candle. How many of you have done that before? You've bought it here with your whole position, seen it offside, and then thought, oh no. Generally, that's not what I like to do. I like to buy around, because we know that support and resistance are not just one price. Absolutely. So why not, try to get in around. You want to be long. Okay, now I'm not saying that you should buy it here, and buy it down here. Okay, because that would be crazy unless you're looking to take, a lot, looking to take like, 1,000 ticks out of the market. But you can do it within a very short area just to optimize your entry. And that actually is a good example. Price then moves higher. And then we come up again. And again, we form a bit of a support level here. Now for me, okay, at this point, I'm hoping we retrace a little bit. At this point, I'm thinking to myself, well, we got a big hammer pattern, so I'm going to buy some on the open here. Okay, we've got a nice hammer pattern. There's a bit of volume in the chart. Okay, and of course, hindsight is a good thing. Okay, so I'll buy it here. And then it obviously comes back and goes against you a bit. Whereas, actually, you've got a nice hammer pattern, so we buy it on the open. But as well as that, potentially, we've got a very good resistance as a support level here. And I'd rather try and buy it around there to make sure I optimize my price. And we can see that obviously price moves on, and so on. So it's up to you how you do things, but it's about having that area, and generally you have got to have more discipline. So, any questions? Now, I've skimmed through it because I have put the PowerPoint presentation in the download box for you that I've made you. So if you take that away with you and have a little look, we will be using advanced scaling during the session this week when we're in the room in a couple of instances. So just bear that in mind. Does that answer your question, Bottle Torch? Good. Now, I'm not saying that this will suit everyone because the problem is I can't tell you the amount of times that I've had a short, something I want to be short, head and shoulders, for example. We break, okay? We break through on this candle. I sell it here, for example, just on the open of the candle. Let's pretend we've broken through the level here. I've sold it here. Market's gone against me. At this point, I'm like, oh my God, oh my God, oh my God. But bear in mind, you know, that is the neckline, and we shouldn't break above that neckline. So I'll sell it again. But, you know, in theory, it's easy. Many a times, what I've done is I've sold it here. I've seen this. I've panicked, and I've exited out of the trade for a loss. And then we can see that price obviously comes off. So it's not easy to do, and it is a more advanced concept. But I just wanted to introduce you to it because you are going to see me doing it in the room a little bit. And it's not that I'm averaging, I've got bad discipline. It's actually planned out. So, see that Gio Elena has got a question. He's got a 4-hour chart. And again, if you've got any charts, guys, I'd love to go through them in the session. That's what these sessions are about. What are you looking for here, mate? So yeah, cable's obviously very, very choppy. Let's pop on that cable chart, shall we, on a 4-hour. What are you looking to do there, Gio Elena? You're talking about looking for a short. Okay, so what I would say is absolutely you're in the middle of a range. So let me just mark up some levels. We can see that we have a big support zone. That was a resistance. I would also say that we have a resistance around here, but that's a green line. And then I would say that we have another green line. I would say it's a potential short, definitely, in my opinion, but I wouldn't be trading it on the 4-hour because the 4-hour range is actually this. Okay, what I would be doing is I would be taking it down to say a 30-minute chart, because on the 30-minute chart, that looks much better, doesn't it? For a short. Whereas on the 4-hour chart, we're actually just in a huge range. So I wouldn't be trading it on the 4-hour myself. I'd be trading it on the 30-minute. And I'll be using very tight money management, my opinion. You know, again, advanced scaling, you might want to sell it here, but it's the middle of the range, so I generally wouldn't do that myself. You know, maybe your stop loss above this support area on the chart here. I don't know, maybe even above here. But, or maybe even, you know, just above this area. We've got a very, very nice, you know, ascending trend. That's not great, but that's okay to use. We've only got one bridge. We've got a nice little ascending trend line, and we do need to get above this area on the chart. But on a 4-hour, it's clearly in a range. You know, it has got a bearish bias. That to me looks like it could come off. But there is one area on the chart you need to be aware of. This one here. Can you see how choppy it is around that level? Well, the same thing's happening. As long as we're below it, yep, bearish. But again, I'd be trading it on a lower time frame. Because potentially we could carry on trading like this. You could do 10 trades on the 30-minute and make more than if you do that one trade on a 4-hour and wait hours for it, because we can see it's a congestion level. So we'll look at your second one. 61.8%, absolutely it is, and it is a very good support resistance area. But you know, potentially though, we could easily trade. We're trading in a range. Let's get that euro up. It is a slight bullish bias in that euro, so let's put the euro up. Get rid of this big patch. Okay, so realistically, range in that euro it's a tough one. Two ranges. We've got a range here, and we've got another support around here, this area. Very hard to pin that down, but realistically at the moment we're in a big range in that euro. It is looking bearish. Again, we have a very, very good support level, but it's in the middle of a bigger range. So again, you know, take it down for me to a 30-minute. We've got some single prints down here that need filling. This area on the chart, and if we zoom out, you know, there is a good support area here that we should stay below. So for me, I'll be trading it again on a 30-minute chart. And there's a question about dollar CAD. Okay, guys, we do have a neckline retest. Yeah, absolutely. Let's have a look at that dollar CAD. 4 hour. It looks a little bit different to mine, but see if there's anything that we've got in the market there. A little bit of a trend. Nothing too good. There's definitely a trend there. Nothing too good. For me, we've got to get below this in this area, but it's also now a new low here. So I'd want to see a break of this 110 level, 110.00, but as well as that, plainly it's only when we break below here that technically that neckline is going to be broken, and it's grinding lower. You want to see it have a move up and then just accelerate. That is just grinding. I think we might move up there. Does that make sense to you? Cool. Again, it's up to you guys to take the trade. I'm not trying to tell you to take the trade. That CAD, you know, I've said it time and time again. You know, it should potentially have a correction. We are forming a big daily head and shoulders, but until we get below there, we're actually in a consolidation pattern, and I think we're going to consolidate. I think we do this, but that's just my opinion. So I'm actually looking to get long on dips. If we look at the RSI, we can see that it's moved out of overbought a hell of a lot, but yet the price hasn't moved. You know, the price has moved, you know, very, very little. We've moved a retracement of like sort of 200, 300 ticks, whereas, you know, overbought down to 50, we've moved 300 ticks, but when we were oversold and we moved up to overbought, we've moved 500 ticks, pips. So absolutely, he does want a weaker CAD, which means dollar CAD goes higher. Right, guys, so nearly at the end of the session. Again, download that advanced scaling in, and what I want you to do, guys, is have a little practice with it. If you've got any questions, I need you to just pop them into the trading room at any point tomorrow and let me know, because it's very, very important that we get to grips with this. What I want to do now before we go, as always, is have a little look at data tomorrow to check if there's anything out in the morning. So we pop our Tradimo page up, as always, and we pop our economic calendar up. We have a little look. Tuesday should be a bit busier. Oh, Fed Chairwoman Janet Yellen is speaking. So we're safe to trade in the morning, guys. Very, very little out in the morning. Absolutely nothing until 2 o'clock, 3 o'clock London, sorry, 4 o'clock our time in Central Europe. So that is the event tomorrow, guys. You're pretty much safe, but just be aware that most dollar pairs will probably be a little bit quiet in the morning, guys. So for me, I'm going to be looking at maybe some of those Asian crosses, possibly even that euro pound, for example. But I think things are going to be a little bit choppy until she speaks. It's a prepared text and a statement. We can talk about what's expected. I'll do a little preview, but it is a statement that gets released, and then there's she reads it out, and then she gets some questions that she has to answer afterwards, which are always quite interesting. Dead market again. Yeah, it'll be busy. It is going to get busy, mate. End of this week. After today, I think we're going to see it get busy. After tomorrow, that Yellen speech is going to get busy. Right, guys, I'm going to love you and leave you now. I have to shoot off. I will be back at 9 o'clock GMT, 10 o'clock Berlin time tomorrow morning for our morning prep, where we'll talk about Yellen, trade setups, and so on and so forth, what we're going to do. I will be taking some trades in the trading room tomorrow again, using our strategies we talked about last week. So let's hope we've got some nice trend in markets or some nice range in markets for us. Until then, gotta love you and leave you. Yeah, love it. It's a saying in England, boy robot. It's a saying in England. Very well known saying. I'm so happy that I love you. Oh God, wish my girlfriend was. Right, guys. I'm going to shoot now. I will be back, as I say, tomorrow. In the meantime, enjoy your evening. Have a read of that advanced scaling and have a little play with it. And if you've got any questions, pop it in the trading room. I'm always about.